Hello and good morning, everybody. A very warm welcome to our budget briefing. My name is Mark Thomas. I'm a director here at Gemini and also our head of advice. The idea today is we've got about 45 minutes together, hopefully, for me to give you an update and an overview of the budget that we saw just over a week ago from Rachel Reeves. I want to try and put this into context of financial planning purely. So I'm not going to go into it all of the whys and wherefores. I'm also going to try to avoid commenting on the good and the bad and the indifferent of the budget. I want to just try to bring you the key changes that I think will affect you as Gemini clients or introducers, and potentially hopefully give you a few different options and things that you can look at moving forward. There will be some time at the end of the session for some questions and answers, so please feel free to drop any questions or comments that you've got into the chat box at the top of the screen, and we'll have about 15 minutes at the end. I'll be joined with some colleagues to help you with that. So let me just share my screen and we'll get into the detail of the presentation for you. Okay, so what you can see there is the Gemini office. Hopefully most of you are familiar with that. I think it's probably an opportune point just to let our clients know that we've had a bit of a refresh, a bit of a rebrand. The office is looking a bit more spick and span and nicely decorated. We've had new windows, new decor, and we've also taken the opportunity to rebrand. We've got some fresh logos and fresh designs just to sort of set the business up and take us forward. We're going to have a new website launching quite soon, so please look out for that. We'll drop you all a note out when that's available. But if you've not been past the office lately, you'll probably notice next time you do come past that things have changed. The flag's gone and there's some much more distinctive signage for you to notice. So hopefully everybody likes that. We're certainly very pleased with it and very proud of it. So back to the budget, back to the task in hand. What I'm going to try to do for about 30 minutes or so is just to walk you through what I think was some of the good news from the budget, what was perhaps some of the not so good news, and what some of those changes are. What the implications are. I think we tried to focus on two areas that we think are most impactful. That's pensions and inheritance tax. Sometimes those two are closely intertwined and can't be split up. But I want to try and talk you through what our take on the key financial planning messages are from the budget, to hopefully give you some reassurance and to give you some ideas of what might be possible now or moving forward. I'll show you the Gemini budget document that gives you all of this and more, which I'll show you how to access that later on in the session. And then we'll have some time after about half an hour for some questions. So the overview, this was, I'm sure it hasn't been lost to your attention. This was the first Labour budget that we've had for nearly 15 years. And actually, I didn't realise this, the first that we've ever had from a lady chancellor, which I think is great and a great sign of progress. We've heard a lot of talk, probably since the general election, of this publicised £22 million black hole in the public finances. And I guess, if anything, Rachel Reeves went further than that and said that she didn't want to just plug the black hole. She actually wanted to raise in the region of £40 billion in additional tax revenue for spending and what she called invest to fix what she described as a broken NHS, school system, prisons, justice and transport. So it wasn't just the £22 billion that we'd almost been set up to expect. It was significantly more than that. The final point there, which I do think is a noble aim, and I think any UK citizens should hopefully understand what's been trying to achieve here, which is that we're trying to balance the books by 2030. So the Labour Party are basically saying by 2030, whatever the country is spending on day-to-day costs, they don't want that to be from borrowing, that they want that to be directly from revenue that's been raised within the country, which I think is a noble aim, and I think it would give people confidence back in the UK and UK PLC if we can get to that point. Nobody wants to be invested in a business that's constantly overspending, constantly over borrowing, and paying significant interest rates on all of that debt. So I think that's a good aim, and I think it would put us all in better stead if we can get there. Okay, so the good news is, I guess some of the really nasty rumours that we heard before the budget didn't come true. So, some positive news there. We did get a few calls from clients talking about wanting to take their tax-free cash. potentially shelter that outside a pension because there was a rumour that tax-free cash limits were going to be withdrawn. I'm really pleased to say that that wasn't the case. The Chancellor didn't change anything in relation to tax-free cash in pensions. Essentially, you can still take a quarter of your pension in retirement tax-free. There is an upper limit on that of the number that you can see on screen, which is 268,275. If you're lucky enough to have a pension pot that's over £1 million, then your tax-free cash effectively tops out at 268,275. That hasn't been changed. That was already in place. There's still tax relief remaining on personal pensions. There was some rumours that that might be withdrawn or reduced, and that's not the case. So the tax incentive is still there to save into personal pensions. I'll go into a bit more detail for you on that later on in the session. There was also some stories that employer national insurance contributions would be added to pension contributions, and there was a concern that that might put some employers off from paying or topping up pensions or paying higher pension contributions, and thankfully that didn't happen. There's no change to the ISA regime, so one of the most tax efficient savings vehicles that we have, and investment vehicles that we have in the UK, remains very, very tax efficient. And also for anybody that's past state pension age and is drawing their state pension, the triple lock remains in place. And I'll just share in a few minutes just some figures with you on that, which is good news. Just in terms of some of the other changes, I just want to step through the main taxes that we're faced with in the UK and just give you a quick reminder of what they are, what they do, and what, if anything, in the budget has particularly changed in those areas. So first of all, income tax. No real change in the budget to income tax. So we will all pay 20% tax on any income over the 12,570, 40% tax then on income over 5270, and if you're lucky enough to be earning over 125,140, then that extra income layer will be subject to 45% tax. No real changes in the budget, but just a reminder, I think this is what Martin Lewis keeps calling a stealth tax, because something that the Tory has introduced a few years ago to try and recoup a few pounds into the government coffers is that they've frozen a lot of these tax allowances and these tax levels. So ordinarily, over the last however many years and decades, we've seen these tax rates and allowances increase in line with inflation. Those limits have been frozen for a few years now, and they are destined to remain frozen until 2028-29 tax year. Effectively, that means that hopefully as our salaries increase or our pension income increases, unfortunately, more and more of that increase will drop into those tax bands because those bandings are frozen. Hopefully that makes sense to everybody. But as I've said earlier, please drop any comments into the chat box if you've got any comments or questions. Capital gains tax. There has been, or there was some significant changes in capital gains tax. And these changes have come into force immediately. Quite often in the budget, we see taxes or we see changes or policy changes that are set for the next tax year or 2 or 3 tax years' time. Sometimes we see changes that are effective from immediately in time, and this is one of those. So just as a quick reminder, capital gains tax is a tax that we all pay if we sell or if we dispose of an asset at a profit. So potentially a buy-to-let property or a second home, potentially a share portfolio, unit trust or collective investments, not ISAs or pensions, but some of those other type of assets. If you acquire that asset and sell it at a profit, then there's tax to pay on that profit. Only if the tax in any particular year is over £3,000, because every individual adult in the UK has got a £3,000 tax-free capital gains allowance per annum. But if you make a gain over £3,000, then the gain is subject to tax. And if that gain keeps you in a lower rate tax bracket, then that gain is now going to be charged at 18%. It was 10, now 18. That's quite a big hefty jump, 80% jump in that particular tax bracket. If the gain is significant enough to take you into the high rate tax banding, then your tax on that will now be 24% rather than 20. So that's gone up 4% from 20 to 24, and that's immediate. So if you were to dispose of an asset today, tomorrow, this month, next month, and make a gain on that over £3,000, you're instantly into those higher capital gains tax levels there. Any gains on residential property remain unchanged, and there's been some tweak upwards also in the business asset disposal relief, which is sometimes called entrepreneurs relief. But we can perhaps go into that in a bit more detail if anybody's got specific questions. I'm conscious that won't necessarily be something that's relevant to the majority of our audience today. So moving on. Pensions changes. So I think I mentioned earlier on that the triple lock has been maintained, which is great news for anybody that's in receipt of state pension or basic state pension, or is likely to be so in a short period of time. So the triple lock means that all state pensions will go up by 4.1% in April next year, which is an increase for the highest qualified pension, state pension individuals of about £470 a year. So the maximum state pension that you will be entitled to from April next year is £230.25 per week. If you hit state pension age before April 16, then your increase is the same percentage, but up to a slightly lower figure of 176.45 per week. Probably for us and our clients, the final bullet point was not one of the rumoured changes that we'd been picking up in the weeks and months prior to the budget. Is probably the most impactful change that we've seen in the budget. And for some people, that this can have a significant impact. And we're going to try and talk you through what that means and what you potentially might be able to do about it to assist. The wording in blue there is taken straight from the government consultation or technical consultation paper. And this is the government's own words, not mine. They're saying that they want to make the inheritance tax system fairer by applying inheritance tax to unspent pension pots. That's the government's words. I think what they're trying to infer there is they're trying to level the playing field so that when a person passes away, inheritance tax is assessed more fairly across all of that person's assets now, including their pension, whereas previously it wasn't. This is due to come in April 2027, and I think it's really important to bear that in mind, because we definitely do not want anybody taking any knee-jerk, quick, potentially rash decisions on this now. I think there's still quite a lot of detail to come out. There's quite a lot of planning opportunities that I think will come out over the next 24 months, and we're going to be here to help you with those. Please don't take any rash decisions now. I wouldn't want, unless your circumstances have changed, for example, I wouldn't want people thinking, oh, I need to access my tax-free cash or my pension and sort of salt it away somewhere else just to protect it from inheritance tax. That may well not be the right thing to do. So it's important that you let us have an opportunity to look at your individual circumstances and needs and goals and what you're trying to achieve, and then give you some advice on that basis. Okay, so let's just talk a little bit more about inheritance tax. On the right-hand side, I've tried to just focus on inheritance tax facts. This is per person, and nothing that's in red here I don't think has changed in the budget. But I think before I present to you what has changed in the budget, it's hopefully helpful just to sort of restate some of the facts and some of the key points to do with inheritance tax. So when we talk about a nil rate band, that means the amount of your estate that you can pass down to your beneficiary is tax-free. Every adult in the UK has a nil rate band of £325,000. So you don't pay any inheritance tax if your estate is worth that amount or less. There's an additional nil rate band called the residence nil rate band, which for each person is £175,000. So you can do the quick maths there and realise that per person, it's generally acceptable in the UK per person to be able to pass down £500,000 of your estate to your beneficiaries, whoever they may be, completely inheritance tax free. What's the level of inheritance tax? In case anybody's not sure, it's 40%. Okay, so it's 40% above those nil rate bands. If you die and you pass an estate on that's, for example, worth a total of £300,000, then there's no inheritance tax to pay. It's just a flat percentage of 40% that kicks in above those thresholds. So hopefully that makes sense to everybody. And as I've said there, for a married couple, it's generally the case that you can pass on around £1 million inheritance tax free. Now, a little bit like the thresholds with the income tax, those limits, those NRBs and RNIBs have been frozen now for a little while. They were frozen until 2028, but Rachel Reeves last week announced that those limits were going to be frozen for another 2 years, so to 2030. So again, if your estate's growing, if your pension assets are growing, if the value of your house or other investments, deposits, other assets that you've got are growing beyond that £500,000 for an individual or £1 million for a couple, then those bands are not going to be increased till 2030. So again, that will mean more of your estate likely to fall into the inheritance tax chargeable band. Just a quick technical point at the bottom, because quite a lot of people might not be aware of this. If you're lucky enough to have a total estate as a couple worth over 2.7 million, and now that pensions are coming into this, we know that we will see some Gemini clients with estates of over 2.7 million. Effectively, that 175 or 350, once it's doubled up, of residence nil rate band disappears completely. So if your total estate as a couple is over 2.7 million, your nil rate band as a couple is 650,000 and not the £1 million. So it just means that you start to pay tax, or your beneficiaries start to pay tax at that lower rate of 650 rather than £1 million. And obviously that can be quite impactful in terms of the final tax bill, especially when we're talking about a tax rate of 40%, which is pretty hefty. Okay, so that's the facts as they stand now. In terms of what's changed, the proposal is we're in a technical consultation period now from the budget date, 30th of October, until January 25, with a view to working out how the government adds inheritance tax to pensions. Previously, pensions have all generally been run and settled under a trust arrangement and a trust regime. And what that means is that the trustee has the discretion about who to pay the benefits to. And previously, those benefits have not been subject to inheritance tax. Effectively, it looks like the government want to dismantle that trust regime, and they're asking the pensions industry to come up with some solutions and to help them to sort of work out how to do that. What we do expect, again, this doesn't come in for another 18 months, so there's no reason to make any quick decisions now. We're going to be able to follow this up with a lot more detail, a lot more sort of options for you over the coming probably 12 to 18 months. This is just telling you what's happening in April 27. What we do expect is there's a real chance that pension scheme administrators are going to be asked to settle an inheritance tax bill directly to HMRC. So, for example, if you have £400,000 in your pension and your estate is subject to inheritance tax already, we think there's a chance that the pension scheme administrator may well be asked to remit 40% of that. So £80,000 straight to HMRC before paying the remainder out to the personal representatives. We're not certain on that yet, but that's what we think the industry might do as a quick and easier, simpler solution. One thing to always be aware of when trying to settle an inheritance tax bill or get probate is that probate tends to only be granted after inheritance tax has been paid. And if the estate is tricky to value, which it can be with properties and different types of assets in there, whatever the inheritance tax bill is, attracts 7.5% interest if the bill isn't settled within 6 months. And I think adding pensions in is likely to add an additional layer of complexity and could see more families, a very difficult and distressing time being faced with, fairly punitive interest rates, 7.5% on any, what the papers are calling death duty that may be due. Okay, there are some exemptions for different types of investments. So investments in the AIM, which is the alternative investment market, will only attract inheritance inheritance tax at 20%. But we've got to be really careful when we use the AIM market. It's a small market, and therefore it could be subject to significant changes in valuation. We can see volatility. We can see companies coming and going quite quickly in that market. So we're certainly not recommending that as a panacea, and we're just going to keep a really close eye on that for you and just try and work out what that means and what your options are. Some other changes, we did see the Chancellor add an extra 1.2% to employers' national insurance. So that takes employers' national insurance up to 15%, and it's also payable on salaries now starting at £5,000. I think it was £9,000 previously. So effectively, any employers in the UK, we might have some employers, I'm sure, in the audience that's watching today, will have a slightly increased national insurance bill. What that does mean is that it's likely to make salary sacrifice a little bit more attractive. Excuse me. We sometimes see employers use salary sacrifice, or employees use salary sacrifice to have a little bit more pension money paid into their pension pot, and it saves employers their national insurance contributions. So we might see that starting to become a bit more attractive as we move forward. Stamp duty payable on second homes has increased immediately. So if you were in the process of buying a holiday home or buy to let and that hasn't completed already, the additional stamp duty that you'll pay on that second home isn't 3% now, it's 5%, and that's effective straight away. And I'm not going to get into too much detail around the residency test and the domicility, but essentially, and I think it's fair to say, the government's trying to shut that tax loophole down in terms of the ability for people to use domicile to effectively have their tax assessed overseas. So I think that that's likely to disappear and present less opportunities for tax planning by moving abroad, essentially. So some thoughts really. What we've done up to now is hopefully just presented you with some ideas of what we think are the key changes, the key facts. What I wanted to do, rather than just leave you with that, is actually share some thoughts with you on what that might mean in a planning perspective. So I think the first myth to dispel is that pensions are not dead. I read the Sunday Times Money magazine at the weekend, or Money sort of excerpt within the paper, and the headline there was "Tear up your pension plans," which I think was a gross overreaction and probably a little bit silly, to be honest. If you want to provide or save money or invest money for your retirement, pensions are still fantastic. Okay, so everybody that puts money into a pension gets tax relief on the contribution. So put quite simply, if you're a basic rate taxpayer and you pay a net premium of £800, the government effectively grosses that up and you have £1,000 invested. Okay, £200 of free money. If you're a higher rate taxpayer or an additional rate taxpayer, it becomes even more attractive and you effectively get your 40 or 45% tax relief, but that comes in via your tax return. So it's not immediate, but effectively you get a discount on your tax bill once you've done your tax return. So there's no other investments out there that will give you that sort of almost free money, really, in terms of grossing up those net contributions. So we think pensions are fantastic for that. Mostly pensions grow tax-free. There's some small technical detail taxes in there, but largely they're tax-free. And still, you can take 25% of your pension pot tax-free up to that magical ceiling of 268,275. Okay, just as a quick reminder, you can take pension benefits as soon as you get to 55, if that's what you want to do, or if that's what you need to do. But if anybody's aged about 51, 52, 53 now, you will want to bear in mind that from 2028, that pension increase or that pension minimum age is increasing to 57. So if you do happen to turn 55 before April 28, you've got a relatively short window in which you can access, for example, your tax-free cash if that's what you wanted to do, or some of your pension income. So if that is you and that's something that you're interested in finding a bit more detail about, please just reach out, speak to your advisor, or drop us a line and we can certainly help you. We do think there's an opportunity for annuities to become more popular. Again, I try and always explain what we mean by jargons. Not everybody understands what an annuity is. And effectively, an annuity is just a way of sacrificing a pension pot or a pension lump sum or part of a pension pot. You don't have to use all of it in exchange for a guaranteed income for life. Annuity rates are actually relatively healthy right now. So we can see some people, depending upon age and the status of the annuity, probably get around 6% return. So £100,000 pension pot might create a return of £6,000 a year for life. And you can guarantee that, and you can provide spouses benefit within that as well if you would like. So we think annuities might become a little bit more attractive. And we think that whilst pensions are fantastic for pension planning and income and retirement planning, they're probably less so now in terms of trying to shelter money from inheritance tax. And we do think there are other inheritance tax efficient investments available. Some of them are really high risk, and some of them are, they're not really the run-of-mill type of schemes that we would use at Gemini for our clients, but there's certainly things that we can look at or provide you with an appraisal of and see whether they're suitable. So if there are alternative vehicles that you might want to consider, again, I wouldn't be doing anything for a couple of years until we watch and see how the dust settles and how the industry is looking once we've bedded in all of these changes. Just the point there, just a couple up from the bottom, there was, whilst we're all wringing our hands and getting worried about the damaging effect of the budget on pensions, particularly in terms of inheritance tax, there has been a survey that's just been published, I think it was last week, by this website called pensionattention.co.uk, that says that £31 billion of our money, there's a UK pension holders' money, £31 billion is now owned by policyholders who are untraceable. They've moved away. We don't have the contact details for them. So if you are concerned that you may have lost track of any personal pensions or previous company pensions, you can go to a pensionattention.co.uk website and they'll carry out a search for you. So there's a lot of money sat in that pot. In fact, more than enough money on its own to plug the black hole of UK finance that we're trying to address in this budget. So let me just move on to some thoughts, some additional thoughts on pensions. So it's a little bit of a technical slide, but I think it's hopefully, once I've explained it, quite simple to follow. Down the left-hand side, you've got the rate of income tax you pay today. So for example, somebody might be 35 years old and they've got a management position and they might be earning over £50,000 a year and they might be paying 40% income tax. If that person in retirement, which is the row across the top, if that person in retirement is not a 40% taxpayer, let's say they're not a taxpayer at all, 0%, or they're a 20% taxpayer, so their income is less than the 50, you can see there the growth that you will get just by taking advantage of those different tax regimes and those tax levels. So effectively, you're getting relief on contributions at 45%, and then you're paying the tax back once you've had your tax-free cash at a lower level without any growth at all in your pension pot. You can see that just the tax relief on personal pensions and the difference in tax that when you're saving to when you're spending can make a significant difference. And you know, we don't really see this type of tax advantage in any mainstream savings or investment product elsewhere. So it really does make pensions quite special and still very, very attractive for building a lump sum for retirement. Inheritance tax, some thoughts. Again, I think probably going back 20 years, people didn't tend to have significant assets in personal pensions. So if they had an inheritance tax bill, there were lots of products and solutions in the market that we could use or that we could give you advice on to try to mitigate that. And I say mitigate that, but only if that's important. We do see some clients that are quite happy to pay or have their estates pay inheritance tax. They don't necessarily want to leave their children a huge lump sum of money. They think that that might be detrimental to their development in terms of, you know, the desire to go out and stand on their own 2 feet. So I don't want to just assume that everybody wants to save inheritance tax or pay no inheritance tax. We definitely have clients that are happy to pay some or all of it. If in fact, inheritance tax is something that you're interested in saving or reducing, rather than just read through the bullet points, what I would say is I'll leave those with you, but there's lots of options and lots of opportunities and lots of different solutions that we can talk to you about in terms of saving inheritance tax. So whilst the pension saving opportunity on inheritance tax has shrunk, there are significant other opportunities and some very simple cost free in terms of buying financial services products, some very simple solutions such as gifting money or using trusts to gift money or buying whole of life insurance cover. So effectively, you insure the likely level of inheritance tax bill and the life insurance policy pays out on second death to cover that bill. So writing those kind of policies in trust is critical so that, again, it definitely stays outside of your estate and ensures that you achieve the objective that you set out with. Lots and lots of solutions on there. So it's really important to remember that the game or the challenge in terms of saving or reducing or removing inheritance tax is still very much open, and there's still very much an opportunity to do that. And we'd be delighted to help you with that if you've got any questions. One thing that we do for some of our clients, particularly where we've had people move defined benefit pensions, or we've got people that are really careful about spending their money through and in retirement, is we carry out cash flow planning. This has become quite popular really over the last few years, and I suspect that cash flow planning will become more and more popular as people want to plan their assets and the use of their assets and the disposal or dispersal of their assets in retirement. So it's a fairly busy slide, but all of the different colours represent a couple's assets or income. And the black line that sort of jigs up and down and goes left to right on the screen is that couple's income need. You can see that the chart starts at the age of 62 and goes to the age of 90. We have some pre-retirement years where we've got assets being used and we've got income from employment. Then we've got the living the dream retirement years from sort of 65 up to 79, 80, where there's growing level of income required, and we can show clients how to get and where best to take that income from. And then we can see potentially a slowing down of expenditure as somebody moves through their 80s in slightly slower years in terms of spending and potentially adventurous pursuits. So what we can effectively do with cash flow modeling is we can take all of your income and all of your assets, and we can look at potential future events like inheritance that you might be expecting, or significant expenditure. Some people want to retire and buy a holiday home, buy a motorboat, buy a caravan, buy that kind of stuff. So we can plug all of that in, and we can give you a really clear picture on how to use those assets and that different income to give you the life that you would really want. So that's become a valuable service, and I expect that will increase as we move forward with these changes that we've seen in the budget. So just before I bring this part of the presentation to a conclusion, I really hope that that's been helpful. My mission today has been to try to answer questions and put your mind at rest about a few things. I don't particularly like some of the more aggressive headlines that we've seen in the press over the last week. I think ultimately it is what it is. The situation is what it is. And what we've all got to do as individuals and us as financial planners is help you to navigate the best and the most successful possible path through that, rather than wishing reality wasn't as it was, because we can't change that right now. Who knows what might happen if we get a different government in 5 years' time. So please, please, please don't make any rash short-term decisions. Please feel free to contact me, contact Gemini, contact your advisor in the first instance, and we can give you tailored, bespoke guidance and advice to do with your specific situation and what your goals and objectives are. And we can make sure that we're matching those and point out all the advantages and the pitfalls to you before you proceed. The pension and tax landscape does get more layered and complex at every budget. That's something I've seen over 20, 25 years in doing what we do. And I think this has significantly heightened that level of complexity. We've got a new government and a brand new budget. So again, let us hold your hand and guide you through that. Ask us about cash flow planning. Ask us about what your inheritance tax liability might be if you don't already know. It's relatively easy for us to give you a calculation and have a look at that. And I guess then once you know what that tax bill might be, you can decide if you're happy with it or if you would like to mitigate it, and then we can start to talk about solutions with you. One of the benefits and the absolute advantages that we've got at Gemini is that we're not just a financial advice business. We also do the asset management side of it. So we'll asset manage and invest your money and manage your money for you as well. But one of the departments that we've strengthened significantly over the last 12 months is our legal services division. So we've got a bigger team in there now. We've got more people, more qualified people. And I'd like to say that we did it in expectance of a budget like this, but I suppose it was just us doing what we thought was right at the time, but it's probably played out quite well, in that we expect that what we do in legal services is we've got qualified lawyers that can help you with preparing wills, powers of attorney, and particularly given the nature of this budget, trust planning, and how you can control your assets and gift your assets and still make sure that you can achieve what you would like to achieve with them. So our financial planning team and our legal services team work hand in hand, but separately, because they're separate disciplines, separate tasks. But they just ensure that we can build a really nice, tailored solution for you to achieve what you would like to achieve. I think that's it in terms of the detail. I just wanted to remind you that if you're on our personal finance portal, and I would encourage you to sign up for that if you're not, because it's a really helpful way for us to communicate with you two ways. And you can see at the touch of a button the value of your investments and your assets and your pension and all that kind of good stuff. If you're not on it, please ask your advisor. We can send you an invite immediately if you've got an email address, and we can get you set up. In the portal is our autumn budget statement. So that takes a bit of what I've said today, but it goes into everything as well, all of the different sort of tax tweaks outside of personal financial planning. So set yourself up in the PFP or ask your advisor to do that if that's something that you don't already have. And finally, just a few disclaimers and risk warnings. So we're authorised and regulated by the Financial Conduct Authority, but it is important to make sure everybody understands that certain aspects of what we talked about today, so trying to give you a holistic view, are not authorised, are not regulated by the FCA, and they're listed at the top right there. And it's important to make sure that I'm very clear. None of what I've said today is personal financial advice. I really don't want anybody to go out and act on anything that I've said. I'm giving you a generic update on what I think is the most important parts of the budget. But please don't take it as personal financial advice. Please talk to your advisor first and get some specific advice on that. And finally, at Gemini, we only deal with UK resident consumers since Brexit. It's pretty common across the financial advice sector. So the information that we've gone through today is only really relevant if you're a UK resident. Okay, so thank you very much. That's the end of the presentation. What I'm going to do now is just opening it up to a few of my colleagues where we can take your questions and hopefully answer those for you. So thank you all very much.